All right. Good evening, folks. Dustin Tate here with the Freedom First Retirement Team. Good evening, good afternoon, good morning, depending on where you are in the country. Pleasure to be here with you all. Going to be presenting on our structurally optimized tax-free income strategy. So at the Freedom First Retirement Group, we've created what I call the structurally optimized tax-free income strategy. This isn't just some Roth account where we've invested in 6-7 stocks, calling it the market, and we're hoping for the best. And this isn't some IRA where we've got the government telling us, okay, well, you can put this much in by that time, and you can take this much out by that time, and we're going to actually keep this much on the back end. Folks, this is a mathematically tax-advantaged strategy that corporations that run this country, families that run this country, banks that run this country have been utilizing for 100, 150 years right in front of our eyes for tax-free growth, for legal protection. No one can touch it. We'll get into all that through this presentation, but before we go too far in, let's take a step back. 2019, last real year before the pandemic unfortunately hit. Things were great. If you look at it from an economic standpoint, things were fantastic. Stock market at all-time highs, record low unemployment, bringing production back to the U.S. It made a lot of sense to invest domestically. Well, we know things have certainly changed in just a short period of time. But what I really want to direct people's attention to on this, the U.S., the government still lost $8 trillion in 2019, which is interesting. You've got economically, the environment had never been better. Again, stock market at all-time highs, everyone was working. Government still lost $8 trillion in 2019, folks. Fast forward 2022, let's fast forward to today. We're at a little bit more than 30 trillion in national debt. We'll dive into exactly what that means. We've added 6 trillion just since February of 2020. Just since the pandemic, we've added $6 trillion in debt, $800 billion through the stimulus package, just through 3 checks. Now we've got 87,000 IRS agents joining the team, and I'm curious where those 87,000 people are lined up to join the IRS. It's a question in itself, but who's going to pay for that, right? We know that it's going to be at least about $80 billion, $100 billion to hire these folks. Where are they going to get the money for this? USDebtClock.org. All right, so if you get bored, you want to start doing some independent research, I highly encourage you to add this, USDebtClock.org. The app is actually really good too, where it's all real time. All these numbers are spinning kind of dramatically, and it's kind of nauseating. But you see here, $30 trillion in national debt. U.S. unfunded liabilities is truly the most alarming number on here. And of course, they've got it tucked away in the bottom right. U.S. unfunded liabilities at $164 trillion. And what is an unfunded liability? Well, total U.S. unfunded liabilities include Social Security, Medicare, federal debt held by the public, plus federal employee and veteran benefits. Folks, aren't all of those things already deducted from your paycheck every 2 weeks, every month? How is this unfunded? It's alarming. Fast forward a little bit. So with USDebtClock.org, it is interesting. You could play around in that for a long time. You can go back to see each president, what their balance sheet looked like. You can go forward to see what things will look like in the future. So in 2025, they tell us what things will look like so they can say, we told you so. Look how the national debt has increased just in 36 months to $50 trillion. Where are they going to get the money to support this? Before we dive in too much further, not enough people realize what a trillion is, what a billion is, what a million is, the million, billion, trillion sisters. They sound identical, right? Well, a million. So if you were to count $1 million, it'd take you 11.5 days. It's a lot of money. A billion, you were to count $1 billion, it's going to take you 32 years. It's a lot of money. A trillion, so if you were to count to a trillion, it's going to take you 32,000 years, folks. So not enough people realize the actual impact and the brevity of what $1 trillion is. And so when they add $6 trillion of national debt just in a matter of months, there's an issue. Again, where are they getting the money to support these programs, right? We know they're printing. We know they've printed a lot. They've printed 40% of all the money ever in this country's history since 2022. Or I'm sorry. They've printed 40% of all the money in this country's history just in 2020. 40% of all dollars in circulation were printed in 2020. And since then, it's been dramatically more. I don't know the exact number, but I believe it's over 60, maybe 80% of all dollars ever printed since 2020. M2 money supply. So this is governmental data that they put out. This is government data that they put out where they tell us exactly how much USD is going to be in circulation. 2000, there was $4.8 trillion in circulation. 2021, there's $20 trillion in circulation. 2025, there's going to be $52 trillion in circulation. In 2029, we've got $135 trillion being printed. Folks, the dollar's not going anywhere. We know that. The liabilities of this country are all fixed. They don't care what happens to the value of the dollar. They need a lot of it out there to meet those obligations. And this is exactly how they're going to do it. Dollar's not going anywhere. But again, where are they going to get the money to support this? Inflation, we know that's out of control. We know it's the highest it's been for a lot of people in their lifetime. Highest in almost half a century. So who's going to pay for all of this, right? People are starting to realize, okay, well, there's going to be some changes, right? Most likely in the tax code. So who's going to pay for this? My clients always say, well, we're going to pay for it, right? And I say, well, who is we? Because we is not just us, right? We is the 1 out of 3 Americans that pay taxes. Folks, in a room of 10 people, 3 of those are paying taxes. 3 people are shouldering the tax bill for 10 Americans at this point. And it's not going to get any better. So I ask, on a scale of 1 to 10, I always ask this in the group sessions, and this gets a lot of activity. How much do you trust, on a scale of 1 to 10, how much do you trust Washington politicians to do the right thing with your tax and retirement dollars? I'll get -10, I'll get 1. The highest I've ever gotten is a 2. Someone said I trust them up to a 2. I don't want the government dictating anything with my retirement, folks. The last group I actually want having any say with my retirement. And so I start to really pry, what's your IRA? What's your 401k? Not enough people realize that your IRA and that your 401k is a government-sponsored retirement account. The government tells you how much you can put in. The government tells you when you can take it out. The government tells you how much they're going to keep whenever they want. And they can change it like that, and they have, and they will. Not enough people realize we are in the lowest tax rate environment this country's ever seen. Tax rates are the lowest they have ever been in this country's history right now. But yet, all these advisors, all these brokers say, oh, let me save you some money on taxes this year. Put your money in an IRA and it'll grow tax deferred. Well, take a step back and think, all right, I'm taking the deduction on $1, yet I'm letting the government then tax that dollar when it's grown to $2, when it's grown to $3, at a tax rate that we don't know what it will be. It's unbeknownst to us. But we've been told that our tax rates will be lower because we're not working. Folks, that's simple farcity. They're the lowest they've ever been right now. Not enough people realize that. And we'll go through exactly how drastic the tax rates can change and how drastic they have changed in this country's history. But too many people don't realize exactly how much money they have in their IRA. You have $500,000 in your IRA. You plan on retiring in 10 years. Well, what's the tax rate going to be? Is it going to be 10%, 20%, 30%, 40%? So is that IRA really worth $500K? Social Security. Again, we know there are too many people on these programs with too few supporting them. There is a drastic change in tax rates coming, folks. If that's not evident to you yet, we might have a tough time getting along. But again, 2 ways for the government to make money. They're a transfer agency. They don't generate any revenue. They can print. We know they've done that, and we know they're not going to stop printing. USD's not going anywhere. They're going to continue printing the dollar. They don't care about the value of the dollar. Again, Their obligations are fixed. More USD is better for them. Now, what's going to put a final nail in the coffin on the middle class, in my opinion, is a drastic increase in tax rates. That's the only other step they can take, and we know that it's coming, and we know that it's coming at the end of 2025. Now, how drastic is it going to be is the question. But folks, I truly believe that in 2x, a 3x, a 4x increase in taxes is going to immediately erode the middle class wealth. Again, I've said it enough, historically low tax rate environment. Just how low are we in? Here you go. Now this is put through the US Treasury, tax rates since 1910. And I want to direct your attention, this is about 1920, 1925, right around the Great Depression. Tax rates on the high end were 25%. Overnight, they skyrocketed 67%. They don't just drastically increase, folks. They don't just step up a little bit. They drastically increase. So again, overnight, tax rates went from 25% to 67%, 78%, 88%. They ended up at 94%. From 1925 to 1945, tax rates went from 25% to 94%. Ronald Reagan, movie star back in the day, would only make 2 movies a year. Why? If he made a 3rd movie, all of the income was eaten by taxes. Folks, that's reality, and that's coming. Not enough people realize that. We are historically in the lowest tax rate environment we've ever been in. And if you think that they're going lower, I don't know what to tell you. I simply don't know what to tell you. Now, let's think about this though, right? 401k back in the day, in 1980, early 80s, late 70s, when it was started by Ted Benna, it made a lot of sense. You had pensions that were underfunded. You didn't have employer-sponsored retirement programs the same way that they once were. So Ted Benna did a fantastic job in creating a tax-deferred defined contribution plan. And that made a lot of sense back in the day. It made a lot of sense to take a deduction. You look at 1980, family of 4 that was bringing in about $40,000 was taxed at 43%. In today's world, that's $140,000. That tax bracket's about 24%. A 2x increase in taxes when the 401k was started. It made a lot of sense to take the deduction. Tax rates were twice as high. Look at the capital gains difference. Folks, the proof is in the pudding here. And when you've got the 401k, you've got the guy that started the 401k saying, do not defer taxes at this point. Yes, it made sense back in the day when tax rates were this high. Look at this. The highest income tax in 1980, 70%. You brought in $107,000, which in today's world, today's dollars, $622,000. Tax rate was twice as high. It's a 100% increase in taxes. You're wrong if you don't think this is coming. Now, what do you do about it, right? Again, if you've got the guy that created the 401k saying don't invest in the 401k anymore, I don't think that 3%, that 4%, that 6% match really matters, to be quite frank. If they increase tax rates 30%, 40%, 50%, that little match that the company's giving you to make sure that you stay in their employer-sponsored 401k plan isn't going to make much of a difference. So this is what I tell a lot of my clients. Familiarize yourself. Familiarize yourself with cash value life insurance. It's been around 100, 150 years. Institutions, banks, the ultra high net worth have been utilizing this since the beginning of time as their tax-free income vehicle. And now we've been told that insurance is a terrible investment. It's not been designed as an investment. It's been designed as a savings program, as a tax-free savings program. Well, there's been some serious innovation in that industry, in which, again, I highly recommend people to do some self-independent research when they get bored. Cash value life insurance, banks in the cash value life insurance, billionaires in cash value life insurance, IRS code 7702. There are a lot of smart people in this country, smarter than you and I, that say this single biggest benefit in the U.S. tax code is the exemption for the cash value within a life insurance policy. That's Ed Slott. Ed Slott's a PBS host. He's not an advisor, he's an insurance agent. The guy tells it how it is. He's called America's CPA. They're saying this for a reason, folks. This administration of all administrations actually expanded IRS Code 7702. And why would they do that? You've got more corporations, more banks, more of the families that run this country stuffing more money into these policies than ever before. Why? It's the tax-free access to the cash value. It's the legal protection. When that money is at the cash value in the life insurance policy of a highly rated mutually held insurance company, there is nobody that can touch it. I hate this guy, and I hate to bring it up, but it seems to always resonate with folks. It's O.J. Simpson. The guy's playing golf probably right now in Florida, where he should be dead or should be rotting. He definitely shouldn't be a millionaire. Now, how is he a millionaire? How has no one been able to get to his money? Well, his advisor put all of it into the insurance programs, various insurance programs, in which no one can touch legally. There's not a government agency, there's not a creditor, there's not a legal entity. Nobody can touch that money between you and the insurance company and whoever else you have listed on the contract. It is a contract. We're not hoping for the best. We're working with a company that can meet every single financial obligation of the contract in a tax-free manner. Now, why does this start to make more sense? They've eliminated the stretch IRA. We know the government needs their tax money, and they're getting it. They eliminated the stretch. Right now, we're in a historically low tax rate environment. That's most likely going to change on the last minute of 2025. And so what do? Again, highly recommend looking into the ability of converting money from a tax me now account or a tax me later account into a tax me never account, aka cash value life insurance. Again, I've heard life insurance is a bad investment. I did too for the first decade of my career. Commodities, futures, options, stocks. And I made my clients a good bit of money. And it made sense to be invested in that world. Well, last 5-6 years, things have certainly changed. The insurance industry has certainly changed. They have given us the ability to operate with the death benefit on a tax-free basis. They've given us the ability to actually grow the money on a double-digit rate of return, tax-free, with no risk. This is the only program that I've ever had in my life where I have clients that volunteer their statement. And this is a good example as to the return capability of these strategies. Now, I'm not going to say this will happen every year, but when you have a tax-free strategy that's built on volatility, which we'll get into if we were to get on a one-on-one meeting, I highly recommend people to get on freedomfirstretirement.com, booking a complimentary consultation. We have webinars on there weekly as well. You could email us, info@freedomfirstretirement.com, and we're happy to dive into this. Again, happy to do a complimentary consultation, get on a Zoom, share the screen like we're sitting at the same desk, show you I'm a real person, but we dive into this and show you how we make this happen, because it's not just some buy off the rack solution. This is structurally optimized. So banks, right, they tell us put the money in the CD, put your money in a savings account, put your money in a mutual fund. You think that's what the banks are doing? Guy that runs the bank put $50 million into a life insurance policy over the last couple of years. Guy that runs AT&T, runs Coca-Cola, $230 million out of the guy that runs Comcast. Folks, they're not putting that money in a mutual fund. They're not putting that money in a savings account at the bank. They're utilizing high growth cash value life insurance. Tax purposes, protection, legal guarantees. So why would banks, why would the ultra high net worth, why would major institutions invest in cash value life insurance? Doesn't Dave Ramsey and everyone else tell us to buy term and invest the rest? Well, I would highly recommend looking into who sponsors those shows, and you'll see that it's securities firms. And you'll also come to realize, well, why hasn't my broker or why hasn't my agent told me about this? Folks, when you're working with some of these defined brokers, you give that salesperson what they are. You give them option A, option B, and option C, but you're only going to pay them on option A and B. Folks, that salesperson is not going to tell you about option C, and they're most likely going to down talk option C. So I highly encourage folks to evaluate independent fiduciaries from an independent fiduciary standpoint, it doesn't matter what investment it is, if it's a stock-based portfolio or a bond portfolio or an insurance program. That is a huge difference maker in just how advisors operate. But again, look into who sponsors those groups and it'll start to make sense as to why they recommend certain programs. Banks, this is great. Banks don't even use the bank as their own bank. And this is what always gets my clients, right? They kind of chuckle, but they don't understand. A bank, they take in $1 and then they have $5 to $10 of obligations. We all know they're extremely leveraged, right? If everyone went to the bank today, 20% of people would actually get their money because of how they operate on a fractional lending basis. Insurance company operates on a reserve system. They take in $1, they have to have at least $1 of reserves to, again, meet every financial obligation of the contract. So proof in the pudding here. I know this is a little dated, but you can see 3 times as much money in these insurance programs than their own bank premise assets. JP Morgan, Wells Fargo, Bank of America, they've got more money in the life insurance programs than they do their own real estate, than their own bank premise assets, and it's not even close. It's a 3x multiple. Since the pandemic, the banks have put 3 times as much money at the insurance companies than they have their own bank premise assets, including their real estate. And this is a good article. Secret sauce that's been right in front of our eyes. Now, the author says, I highly doubt it was some swoozy insurance agent that bamboozled the insurance companies into buying billions, trillions of dollars worth of cash value life insurance and why they treat it like a golden asset. I'd highly recommend familiarizing yourself with this world. Again, the media is starting to push. When the mainstream media is starting to talk about it, it's something to look into, right? But again, you look back, IRS code 7702, there was no articles written on that. Why? I truly believe that if everyone was well-versed in this strategy, if everyone could do it, they would. There would not be a mutual fund industry. Folks, I come from the mutual fund world. Those are the first 10 years of my career. Very few out there designed to benefit you and I. People don't realize these are all designed for tax-free cash during retirement. It's not about the wealth transfer. It's about the tax-free cash while we're alive. Tech billionaire, biggest insurance policy ever, did not put $200 million into another tech fund or another tech startup. Why? The tax-free nature, the protection. And I know that this is grim, but it also resonates with folks. Everyone asks, well, how solvent are these insurance companies? Folks, these insurance companies put out a stat, again, very grim. Everyone could die today. Whole world could end. They pay out every single death claim there is. For whatever reason, the world has ended. They pay out every death claim. They still have enough money to continue operations for another century. Folks, there's not another financial intermediary out there that can say that. A few strategies using structurally optimized life insurance. COLI, corporate-owned life insurance. BOLI, bank-owned life insurance. Highly recommend looking into that. Tax deductible to the business, tax neutral to the owner. It's really for the tax-free income that's generated from these policies. Leads me right into the more individualized program, whether it's an IRA conversion, a 401k conversion, using policy values to actually cover the tax bill, moving money from tax me later or tax deferred or tax now into a tax never strategy without the tax dollars coming out of your pocket. Highly appreciated asset sale using a 7702 policy as the tax chassis. Multiple programs that can be used on this. Cash value life insurance 101, certainly something that we would get into on a discussion. freedomfirstretirement.com. Hop on the calendar, book time at your convenience. We'll get on a Zoom and I'll walk you through exactly how all this stuff works. But it's interesting from a financial intermediary standpoint how these insurance companies have been standing 100 and 150 years with less than 1% of their assets ever being impaired. Something that needs to be explored. So more mainstream media, 401k plans no longer make much sense. Biden eyeing tax rate as high as 43%. Folks, they're going to eat the middle class. They are going to tax the middle class to death through an increase in tax rates, and it's not going to be gradual. It's going to be dramatic. And we need to take action before the government takes it for us. That's what we're about. That's what we're here. That's what gets me up every day. Someone's going to take action. Now, is the government going to do it first, or are we going to take action first? Estate tax changes. You're going to wipe out small businesses. Nixing the stepped up in basis, that's a tax on everybody. This is a good article. Again, when the mainstream media is talking about it, folks, it's coming. Get out of the tax rate time bomb. If they stepped up in basis, that is a tax rate hike on the entire country. The article does a good job of discussing, but it's really talking about a middle-class lady who's going to end up owing almost $100,000 when she inherits her uncle's condo versus virtually owing nothing with the stepped up in basis. You guys got to realize the stepped up in basis is huge for real estate. So I ask, what are you going to do about it? Someone's going to do something. We know tax rates are not going down. So I highly encourage to explore the ability to generate tax-free income, to protect your retirement, and to gain control of your retirement accounts. So the offer, tax-free income analysis, a tax efficiency checklist. Let's inventory your assets. Let's see what we can optimize on a tax basis. Let's see what we can optimize on a protectionary basis. But it's really all about generating tax-free income. Folks, again, Dustin Tate here, the Freedom First Retirement Team. This is our structurally optimized tax-free income strategy. And I look forward to speaking with you one-on-one. I look forward to seeing you in one of our group sessions, or hopefully we can get on the phone. Again, if you want to email us, it's info@freedomfirstretirement.com, or I encourage you to get on freedomfirstretirement.com and book a complimentary consultation. Thanks, folks. Have a great night.